there's another whole range of investments that relate to interest rates that are often ignored because of the tax changes that have taken place. And I'm talking about fixed income mutual funds. Santosh Joseph, the founder of Germinate Investor Services, joined me to talk about that. Santosh, thanks as always for taking the time. And we've often spoken about this segment. Given that 50 basis points possibly still has to come through in the way of cuts, one would argue that long duration bonds look very attractive at this point, and yields going down would be significantly beneficial. Should investors go out and buy these fixed income mutual funds?
Absolutely, Alex. Right now, we in a softer interest rates scenario that we are presently in, buying bonds makes sense, and at some level, the nature or the maturities of the bond will make a big impact. Now, when you buy a 3 to 5 year bond, you make some decent gains, but when you buy a longer dated bond, you get to benefit the full extent of the softer rate regime, interest rate cut possibilities. So, in the fixed income category, when you buy the modified duration, which is slightly more than 3 5 years, you get to benefit, and the returns that you tend to make will be front-ended in the accommodative stance that we are presently in. That there's a smart move there.
What are the options available? And for those that don't know about it, by the way, as things stand right now, the tax treatment is that irrespective of what gains you make and the interest that you earn from fixed income mutual funds, it is treated as short-term capital gains tax, and it is taxed at slab rate. So, Santosh, with that caveat, if you are still to take advantage of this, how should you go about it?
See, I think today the fixed income basket is at a flat level playing field. Mutual funds do not have that benefit any longer in the last year or so, which means you only play for convenience, liquidity, and the benefit of a slightly higher return. Therefore, when you look at the fixed income mutual funds, especially the bond or the other category where you can play the duration in an accommodative stance or in a softening interest rate regime, you are on level playing field as far as interest rates, taxes are concerned, but the yield could be slightly marginally better for you. So therefore, you have to be careful that not all the funds will give you that alpha in terms of return. You will have to choose bonds which are dated, which means you have a reasonable amount of maturity captured within the bonds, because the longer the maturity, the more sensitive they're going to be to interest rate cuts. And when I mean it's sensitive in a falling interest rate scenario, which means you'll get a slightly higher return. So therefore, even when you're choosing fixed income, it's not across the board. You have to choose bonds and bond categories which have modified duration, which is slightly on the higher side for you to benefit from a softening interest rate regime.
Would be a gilt fund, Santosh, or a corporate bond fund. And also, you would have to get out at the right moment as well, because at this juncture, you have yields that are likely to fall further. They've already fallen. And so you're trying to capture the fall in the yields so that you get that price appreciation. Remember, of course, when we're talking about bonds, the movement of yield and the movement of price are opposite. So you're benefiting when the interest rates are falling. With that in mind, Santosh, corporate bonds funds and gilt funds?
So, Alex, you were right. It's the inverse relationship between the yield and the price of the bond that you just made. It's very important that the customer actually has got a great sense of time as far as this is concerned. When you stay for too long, the yields get normalized. If you don't get into the right basket, you don't get the necessary yield. Now, what are we talking about? If you're talking about gilts, we're talking about slightly on the higher end of the duration curve, because traditionally gilts are issued in 5 year, 10 year, and 30 year maturity. And like I was explaining earlier, in a softening interest rate regime, the longer the duration is, the more sensitive the bond price is going to be, and therefore the advantage to make a return. Now, when you talk about GSEC, it's going to be a little more aggressive from a positioning perspective, but you'll also be rewarded with a higher yield or a higher return into your portfolio. Therefore, it's important to notice that when you choose a corporate bond versus a GSEC, you're playing on a slightly higher duration. So gilts tend to be a little higher, and corporate bonds are typically between 3 years to 5 years. But in gilts, you got 5 year, 10 year, and 30 year. The 10 to 30 year will have the highest sensitivity, therefore the possibility of a highest return. So choose your lower risk appetite little bit over there. If you notice, most portfolios, they normally the modified duration stays between 5 to 7 years or 8 years. There are some who will take a very aggressive call based on the situation at hand, and even the outlook that they have for interest rate cuts. But yes, the opportunity of corporate bond and gilts both are there. Gilts are slightly on the longer term, which means more sensitive. Corporate bonds are a lot more within the comfort zone.
Okay. Pure bond fund or hybrid is the question that a lot of people are asking, and people are veering towards hybrid because of the tax aspect. Do you think that that's the right approach?
Absolutely hybrid, both in terms of taxation and even in terms of the selection of the papers within the product. Now, when I mean hybrid, I'm talking even about a mix between corporate bond and G-Secs from a portfolio diversification perspective. Now, when you buy some mix of corporate bonds and G-Secs into the portfolio, you're not missing out the benefit of both, and therefore also you get a slightly better taxation benefit.
Okay. So which hybrid then? If you are saying that hybrid as a category, there are several to choose from. Which hybrid?
So within the hybrid category, so you have the conservative and you have an aggressive. I think here you go in the conservative and you choose something which has got a modified duration close to 5 years, because there you can get to benefit from the modified duration sensitivity and the yield that one could expect out of it.
And which few names stand out to you?
So you have some guys like Nippon and Bandhan have a great track record in this particular space, and they also have a good mix of corporate bonds and G-Secs both playing out well for you. So that benefit is that, see, there are some corporate bonds that don't touch G-Sec, there are some G-Secs that don't touch corporate bonds. I think as an investor, you want the benefit of both.
Okay, fair point. The last point is that I've come across, and this is anecdotal evidence, of course, Santosh, where people are trying to take advantage of bonds that are being sold by platforms, and these are corporate bonds that they don't normally have access to, maybe AA rated corporate bonds, so slightly lower rated corporate bonds which have a higher credit risk, and they're trying to capture 11% yield or 12% yield. Is that a good idea?
Well, all things are good when the yields are good, but that's when you look beyond just the yields and look at what is the risks involved. Now, there are many platforms today that enable an investor to directly access the bond market and buy the bonds. Now, these are good if the ratings are good and the company who's the issuer is good, and you have your basic checks and balances into place. Another very critical factor that I think investors should be aware, unlike in a mutual fund or in a fund structure where liquidity is not much of your concern, here you will have to be a little concerned about liquidity, because the liquidity of the bond and the price at which you get the liquidity will actually impact your total yield that you make. So therefore, if you are an investor looking at these high yield bonds that you can directly purchase, you will do well if you can, kind of clear out which is the paper that you want to buy, and also may do better if you hold to maturity, which is hold till the paper matures and you get the whole payout done. Because I feel that a bit of a risk or kind of liquidity risk that you may face is when you want to liquidate in the interim.
Got it. And that's a fair point. Credit risk funds, of course, a little bit, well, not necessarily the most attractive because of the tax aspect. You are taking significant credit risk, despite the fact that a lot of fund managers are risk averse. Santosh, perhaps it's a conversation for another day. I think we've covered quite a lot of aspects today, and hopefully this is beneficial. Thanks so much for joining me.
Thanks, Alex.
All right, that brings us to the end of this edition of Your Money Matters. Let us know what you think, what you'd like to listen to, and what you'd like to know about. You can write to us in the comment section. Do stay tuned, lots more coming up on NDTV Profit.